Welcome to Advisor Wars, the podcast where we take a critical look at the key issues facing the financial advisor profession. I am Bob Hoopsher, and co-hosting with me is Joe Halpern, Managing Partner and Chief Investment Officer of Obsidian CIO. I was the founder of Advisor Perspectives and led it as CEO until 2024. We're recording this in late February, and this is our fifth and final episode on alternative investments. So over the next 30 minutes, you'll hear from an advisor who uses alternatives in client allocations. You will learn how he sources and researches investments, sizes each client's allocation, the opportunities and risks he has uncovered, and what the ultimate benefit is of alternatives that has accrued to his clients and to his firm. Our special guest is Scott Welch. Scott is the Chief Investment Officer and a partner at Certuity, a large multifamily office serving ultra-high net worth clients. I've known Scott for almost 20 years, starting when he was the Chief Investment Officer at Fortune and later in his senior roles at Dynasty Financial Partners and Wisdom Tree. So Scott, let's start off by having you tell us about Certuity. Who are the clients that you serve and what does your role there entail?
Thank you, Bob, and thank you, Joe, and thank you for having me here today. Bob, I think when you and I first met each other, I still had hair. But Certuity is as you mentioned, it's about a $4 billion multifamily office based in North Palm Beach, Florida. We have offices or advisors in South Florida, New York City, Atlanta, Nashville, Colorado, and a couple different places in California. So we have nationwide presence or footprint, if you will. Most of our clients are high net worth to ultra high net worth families or individuals. Almost all of them are qualified purchasers as it pertains to this topic today. So they have access to all kinds of alternatives and private investments, and it does play a pivotal role in our portfolio construction.
Great. So what is the investment philosophy that you use? Do you have a preference for passive or active vehicles? And what are your core allocations?
Yeah, that's a good question. So the way that I would describe it is it's a modified version of the endowment model. In other words, the endowment model is for institutional investors who don't pay taxes, have infinite time horizons. When you're dealing with individuals and families, of course, that's not the case. You have taxes, you have people who change their minds, whose circumstances change, and so you have to be able to adapt and adjust. But the underlying philosophy is very similar in the sense that we believe in global diversification. So our portfolios have a very healthy allocation to non-U.S. investments. We are both active and passive users because the two things that any advisor can really control the most are fees and taxes. So if a passive strategy makes sense and it's at a lower cost and more tax efficient via an ETF or something, we certainly will use that. We do think that active management can play a role, so we use both. We encourage our clients to have a reasonable time horizon, so call it 5 to 7 years. And based on their personal liquidity needs, their cash flow needs, their risk tolerance and objectives, we allocate fairly extensively to alternatives and private markets.
So Scott, I want to get a little deeper onto that on the alternative side. I think of alternatives as investments outside of public equity and public credit. So from a exposure standpoint, hedge funds, private equity, private credit, and the like, and from a structure standpoint, interval funds, tender funds, limited partnerships, closed-end funds, et cetera. Does that align with your definition?
Mostly. I have a slight difference with you, and I'm in the minority on this, but I define alternative investments as what the industry might call hedge funds. So long, short, global macro, event arbitrage, whatever you have it. And to me, it really just represents super active management. And so that's alternatives in my book. And then private markets are something completely different, right? So private markets, as you indicated, they're available in a variety of different structures. The early days, they were all drawdown features or limited partnerships. That probably still represents the bulk of the assets in the industry, especially on the private equity side. However, private credit has evolved a lot over the last 5 or 6 years with the evolution of evergreen funds, tender offers, interval funds, and things like that. It's coming under a little bit of scrutiny right now. There's been a lot of media noise about private credit. We can talk more about that if you want to. I think a lot of it's a little bit overblown. But the bottom line is that private credit, from a structural perspective, aligns very well with the evergreen facility, even though there is some kind of liquidity mismatch sometimes, or could be. But people really like it, and so I would say that the bulk of our new assets in private credit, have been going into evergreen structures.
That's helpful, Scott. So I'll adjust just so we're talking the same language. So is it fair to say you have public markets, then you have private markets, and then you have alternatives, and the private markets are still different? Is that fair?
Yeah, I mean, I think private equity is still equity, private credit is still credit, right? So if you're talking about how to fund those allocations, that's the natural funding sources would be out of the public side of those versions of those products. On the alternative side, I think of them more as a diversifying strategy. In other words, they're strategies that are designed to move lower correlation to the public equity and bond markets, and so it's in there as a diversifier, less so as maybe an alpha driver. Whereas with the private markets, you're hoping to capture some of the leverage and illiquidity premiums and generate a little more performance.
Okay, excellent. So how do you identify clients that are suitable for alternative allocations, and as well as how do you think about allocations to both private equity and private credit when identifying those clients? So in terms of full construction of a portfolio on their behalf.
Yeah, one of the characteristics of Certuity as a firm is that the planning always comes first, right? So the first step in the discovery process with any new client or prospect is to figure out what their risk tolerance is, what their objectives are, what are their cash flow needs, and then the portfolio construction follows from that. So generally speaking, most of our clients are already pretty wealthy, right? So our job is not necessarily to get them wealthy, they're already there. So our job is to keep them wealthy, grow their portfolios at a reasonable rate, generate the cash flows that they need to live the life that they want to live, and make sure that there's enough at the end to meet their legacy or philanthropic goals. Given that, that conversation drifts naturally to either credit or equity on the private side. If you have a family who wants to generate more income to live a better lifestyle, or to for whatever reason, you might lean in a little bit more into private credit. If other families are living the life they want to already, but want to grow their portfolio either for legacy or just whatever purposes, then you might lean a little bit more into private equity. Most of our clients have both in their portfolios. And let's focus on credit for just a second. Because we do have access to private credit, and because there is some illiquidity and leverage built into private credit, our public credit strategies tend to be pretty plain vanilla, right? So we're not diving into high yield or CLOs or sort of niche strategies. The public side of the credit market is pretty straightforward down the middle, investment grade bonds, either munis or taxable. And then to the extent that the client wants to generate additional yield, we tend to lean into private credit. On the private equity side, it's generally, the bulk of private equity today, if you look at the assets, is still in the growth strategies and in M&A and things like that. Those markets have been a little quiet recently, and so while we certainly have exposure there, we try to find a little bit more niche-y things for our clients that are more interesting for them, perhaps. We do a lot of things in sports investing. For example, we do some direct deals, some co-investments, secondaries, GP stakes, so things that are, they're fully developed markets, but they're not the bulk of what people think of when they think of private equity.
Thank you, Scott. When you look at this universe of private credit, private equity, and alternatives, where do you source your candidates for potential investments? Do your ideas come from brokers or clients or other RIAs or family offices, or from somewhere else?
Yeah, that's a good question. And we're in a nice spot there, a fortunate spot as a firm. We're not so big that we have to stay with just the big players in the space, because we're putting hundreds of millions of dollars to work, like an institutional investor or a big broker dealer. But we're big enough, and our clients are sophisticated enough that we never lack for new ideas, right? So we get calls every day, literally every day, from firms who are want to do business with us. Our clients bring us good ideas. Our prospects bring us good ideas. We have a couple of partners who help us with sourcing if we ask them to. So we're never at a loss for an interesting idea. It's really just a question of finding out what's appropriate for our clients, going through the appropriate due diligence, and then getting our clients invested into it. One thing that's a little bit different for us, maybe that's worth a minute, is we have something that we built internally just for Certuity clients, so it's not a commercial product, called Alts Plus. And you can think of it as an access platform. So when we add a new manager to our lineup or to our portfolio, they may have an institutional sized investment minimum. But we run the program, we run that fund through the Alts Plus platform, and then our clients can access that fund at a much lower minimum, $100,000, $250,000, or whatever. And it's not a fund to fund. So maybe let's say there's 12 or 15 strategies that currently populate the Alts Plus platform. Our clients pick and choose the ones that they want. And then at the end of the tax year, we handle all the capital calls and the reporting and everything else. And then at the end of the tax year, if they're, say, invested in 4 or 5 of those funds, they get one consolidated K1 for tax purposes, which makes us very popular with their accountant. So it's a little bit different, but by doing that, we can still get access to the institutional size managers, but we can make it available to our clients at lower minimums. And our philosophy from a sourcing perspective is that we would rather have deeper relationships with a smaller number of managers versus having a fund exposure to every manager out there. So we have a lot of managers on our platform, but we really try to concentrate on a small handful. We get better economics from them. We get shown deals first by them. We've developed really good partnerships and relationships with them, and we're pretty happy to do that versus just accepting everything that comes across the plate.
So you mentioned diligence, and I'm curious, once you find a candidate to consider, what does your diligence process look like? Do you analyze things internally, or do you rely on outside data or analysis? And what percentage of deals that you're shown actually make it through your process to become an investment?
So the answer to the second question is a very small number. Like I said, we're about $3.5–4 billion or so. So it's not like we need to add 12 funds a year, right? So we might add 2 or 3 or 4 funds in a given year based on availability, interest, how interesting the strategy might be. The due diligence is, I think it's probably very typical due diligence that any good institutional investor would do, right? So we focus on the 4 Ps, right? The people, the philosophy, the process, and the performance, right? So you have to, we try to work with people who have been in the business for a long time. They have a track record. They've worked together for a while. We tend to be a little more biased toward established funds versus trying to be the first investor in Fund 1, for example. We'd like to see the track record. How do they plan on making money, right? What's their investment philosophy? Do we believe that can be done successfully and consistently? What's the process for deploying that investment philosophy? And then what are the numbers? Right. So as you both know, when you're talking about private markets or alternatives or hedge funds, the operational due diligence is as important as the investment due diligence. The numbers are the numbers, but you have to, verify all their service providers. You have to do site visits. You have to do reference checks. So there's an entire process. And then we do work with a third party, an outside firm that can help us with underwriting if we ask them to. We tend to do it ourselves, but they've been very helpful as a partner in terms of idea sourcing and comparative analysis. But we typically do most of the heavy lifting internally, which then runs through our investment committee, of which I'm the chair. And then if it meets the approval of the investment committee, it gets added to the platform.
So, Scott, now you have a product on the platform. How do you integrate that product into a household's existing portfolio?
That's kind of that's the art, isn't it? As opposed to the science, right? So part of, at least in my opinion, part of private market investing is making sure that you have the interest in it before you go through. It's a lot of work to bring a product onto your platform, right? So you want to make sure that there's demand for that product with your clients. So a part of our due diligence is canvassing our advisor base and making sure that there's interest in whatever the product is that we're looking at. So, sports investing is a good example. We partnered with a firm to make available to our clients a minority stake in a professional sailing team, right? That's a little bit off the run, but our clients loved it, right? That it was either they're sailing fans or they realized it's an uncorrelated allocation within their portfolio. So it was something that we did our full due diligence on, brought to the platform, and met our commitment to the fund, in a matter of a couple of months, right? So that it's a give and take, right? You don't want to just throw something on the platform if nobody's going to buy it, or not, there's no interest in it, or if it looks like something else that's already available, right? So you have to. It's a constant give and take.
So in that instance, is a client who loves it allocating some amount, or you're working with them on the allocation to the?
Yeah. I mean, every client's different, right? And our advisors have the ability to customize their client portfolios to meet the specific objectives, cash flow needs, return desires, and so forth. So it's not like everybody gets put into the same model. We do have model portfolios at Certuity that I oversee. But it's a framework. It's an allocation profile, if you will, that we encourage our advisors to start from and then customize. And so if you gave me a blank sheet of paper and I knew nothing about the client, and I'm just creating a hypothetical model, somewhere between 20 and 25% of that portfolio is going to be allocated to hedge funds and private markets. And then that number can go up. The math supports a heavier allocation of those kinds of investments, but most people have a liquidity threshold where they don't want to lock up that much of their money into either semi-liquid or illiquid things. And so 20 to 25% seems to be it's enough to move the needle on the performance of the portfolio, but it doesn't lock up the majority of their money from a liquidity perspective. And so that's if you looked at a typical Certuity client portfolio, that's probably what you'd see.
Okay, and then on the operational side, what goes into integrating those alts, right? So you approved it, you have households who want it. Talk a little bit to the operational side, what may be automated, what's a little bit more manual in nature, what some pain points may be.
Yeah, well, I mean, anytime you're dealing with limited partnerships or drawdown structures or anything that's not publicly traded, you have operational challenges, right? We're constantly automating, so every year, every month, the technology evolves and we try to keep up with it. So to make our operations more efficient, we do have a fund administration team. They handle the capital calls. They handle the performance reporting. We partner with third-party service providers for all of those things. We're in discussions right now with a firm that's applying artificial intelligence to, again, streamlining the due diligence process. We haven't made that jump yet, but it's coming, right? Artificial intelligence is everywhere, and it's coming to our business too. And we already use it in a variety of other ways, but with respect to the due diligence, that's still pretty manual. Because you have to talk to the people, you have to go visit them, you have to kind of touch and feel the strategy. But there is things that technology can and will make more efficient, way more efficient as we move forward.
And you touched on this. Yeah, you touched on this a little bit earlier when you mentioned, which is pretty cool, just being able to kind of unify K1s, et cetera.
Yeah.
But can you speak for a minute just on the client reporting process dealing with these alts and non-traditional products?
Well, yeah, I mean, we use a third-party performance reporting system. I'm not here to advertise anybody, but it's a well-known firm, and they handle a lot of that for us. We also have a trading partner who handles a lot of the trading for us in cash flow management and things like that. We use fund administrators, and it's not atypical to what anybody else does. And some of it's manual, but we do have a team here that handles that sort of thing. And then all of the client reports are generated, through this partner that we have, and we include the alts and privates into it.
Scott, I want to come back to something you mentioned earlier, some perhaps troubles in the private credit market. Can you elaborate on what you're seeing there now?
Yeah, I mean, it's kind of all over the news. There was the infamous quote about cockroaches that came out a few months ago. You may remember that. And what was ironic about that is that the two big defaults that happened that kind of made the news weren't private credit deals, right? They weren't in private credit portfolios. But it's kind of spooked the market a little bit. Everybody still, if you're old enough, if you're as old as we are, right, guys, you remember the great financial crisis and you remember the credit crisis that happened alongside of it. So everybody is looking for trouble in the credit markets because we've had such a great run over the last 5 or 6 years. When Silicon Valley Bank failed and First Republic and some of those other regional banks, the public lending sector withdrew a little bit, right? They stopped lending as much as they had been in the past. And that opened the door for private credit, right? Because those companies still needed funding, but they weren't getting it from the bank syndicated loan market. And so private credit, that plus the evolution of the Evergreen facility just caused private credit to explode. And it's still very popular. There's a lot of folks who got into the business recently and maybe shouldn't have. And this is true with any private market investment. We try to stick with people who are top quartile performers, because much more than in the public markets, top quartile managers in the private markets tend to stay top quartile managers. There's a consistency of outperformance, and so you want to make sure manager selection is critically important in the private markets, and that's true in private credit as well. So we have a lot of allocation, a lot of exposure to private credit. The portfolios are in fine shape. The default rates are low. The delinquency rates are low. We pay attention to things like PIK debt and whether or not that's increasing, because that's, to me, potentially a sign of some cracks in the private credit market. If you're lending money to people who need to pay you back by taking on more debt, which is what PIK debt is. So there's some things out there, and there'll be some shakeups, but one of the things that's happening that we're paying attention to is the bank syndicated loan market has kind of revitalized itself. It's coming back. And so if you think about when people talk about private credit, what they typically think of, and of course it's much broader than this, but what they typically think of is direct lending to middle market and upper middle market companies, PE-sponsored firms, right? The direct competitor to the credit side of that equation is the bank syndicated loan market. So when that market was quiet, private credit exploded, right? Because again, those companies still need funding. But now the bank syndicated loan market is coming back, and it's getting into the market again. You can see that if you just look at the growth in the AUM of the CLO market, right? Because that's what happens, right? The banks syndicate the loans and they bundle them up and securitize them out via CLOs, which is one of the reasons we like private credit versus that market. Because we think that the due diligence has to be a little more rigid or a little more robust, if you will, in the private credit side, because they hold the loan, right? They don't. There's a secondary market, but it's not very big in private credit, and so if you're the lender, you're the lender, and so that's one of the reasons we like private credit. But one of the things that we're aware of is that as the bank syndicated loan market comes back, that's going to put increasing pressure on the direct middle market lending space, and so you have to watch for whether or not you're getting weaker terms, weaker structures, worse pricing, things like that. We haven't seen it yet with the managers that we work with, but it's something that we're paying attention to. And, there was some noise about a couple of the big funds, and to the extent that they were publicly traded, they've all gotten crushed in the stock market. But you have to separate that from what's happening with their underlying loan portfolios. And so I feel bad for them because they're on the news every day trying to explain to everybody that things aren't as bad as the media is making it out to be. And I think that's true. I don't think it's as bad as the media is making it, but they're sailing into a headwind right now.
It's a very interesting perspective in terms of the types of issues that someone in your position needs to be thinking about as you navigate the various markets that you're investing in. Scott, in a minute or less, can you offer one or two key takeaways for advisors, RIAs who are thinking about beginning a allocation for their clients into alternatives? And alternatives, broadly speaking, including private credit, private equity.
So I think the best advice I can give someone is you have to be invested in this, right? It needs to be a core part of your business philosophy, a core part of your investment philosophy. It's not something to play at, right? So it's not like, what's the best hedge fund? Right, you have to have professionals who know what they're doing. You have to be working with partners who know what they're doing, and you have to make a big enough of an allocation within a client portfolio for it to make a difference. But you still have to manage liquidity profiles and things like that. And it's not a one and done solution. There's no single best strategy. It has to be a core part of your business, or just don't bother with it. Just don't bother with it.
Joe, let me put a question to you. Also, in a minute or less, given what Scott has been talking about here, what do you see as the ultimate benefits of using alternatives for RIAs and their clients?
So starting with clients, there's two benefits. One is diversification of their portfolios, and second is opportunistic investing. For the advisor, there's a huge benefit in client relationships. One, alternatives are viewed as a premium solution. So just by offering alternatives, you're thought of as premium. Second, alternatives provide really interesting narratives. Scott mentioned sail racing. Amazing, really interesting, something you could talk about on the golf course. Three, that increases conversations. You're now speaking to your clients more frequently because you're bringing them compelling, premium ideas. And then finally, four, it's going to attract larger clients that can actually afford to invest in alternatives. So those are really the benefits for the clients and the benefits for the advisors.
Joe, I know there's a white paper that is linked to this episode in the notes. Tell us what is in that white paper and what advisors can expect to learn from taking a look at it.
Thank you, Bob. Most advisors will never make it to $1 billion of AUM. And it's not because they're not good advisors. It's because they're trying to scale $1 billion AUM business with minimal infrastructure, with the infrastructure set for 100 million or smaller RIA. And the industry's changed. High net worth clients now expect institutional caliber portfolios. They want alternative allocations. They want tax optimization, and it all needs to be fully integrated. So it's not this model marketplace anymore. It's way more complex, way more sophisticated. It's way more than just good service. And that's why fewer than 6% of RIAs ever cross that $1 billion threshold. So this white paper breaks down the 3 scaling traps that advisors face and why reaching the next level really requires institutional investment capabilities, alternatives, due diligence, proper sizing, and all the technology that integrates portfolio construction and implementation at scale. If you want to build an enterprise, not just run a lifestyle practice, this white paper provides the roadmap.
Well, thank you for listening to Advisor Wars with Bob Hoopsher, Joel Halpern, and our special guest today, Scott Welch. To learn more about Obsidian CIO or Joe's work, we'll include his contact information and a link to the firm's website in the show notes. You can also find Advisor Wars on Apple Podcasts, Spotify, YouTube, and we'll include a link to connect with us on LinkedIn. Stay tuned for our next series of episodes when we turn our focus to tax management. We have a number of guests lined up who will help us understand the various ways advisors can lessen the tax burden their clients face with their investments. Thank you.
Obsidian CIO sponsors the podcast to further education and critical thinking about the factors that affect markets and investing. And the podcast does not provide investment advice. Investment advice is offered only to clients of Obsidian CIO who have entered into an advisory agreement and with whom Obsidian CIO has identified individual objectives, risk tolerance, and other investment needs.